Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
In every show, we answer your burning trading questions and cover all things from the world of trading. So we're back, and
we are indeed. And you've got a you've got a trader's story for us here.
Yes,
it's quite an interesting one.
Yes. So the title for this is focusing on the good times. So I bumped into a guy, and he was he asked me what I did, and I said I was a trader and a money manager, and his eyes lit up, and he started telling me about the fact that he'd been trading for a couple of years. He was actually in a period where he wasn't trading, and I kind of knew where the story was going. And then he said, yeah, I had this really, really good trading period. It was about a month, and I made the best part of 20% in a month. And he was reminiscing about all of the trades, and you could see on his face, he was, thinking back. It's like somebody who's sat with their buddies in a bar reminiscing about the good times. And then, of course, I asked him some questions. Okay, so what happened? And he said, well, I over leveraged, got too overconfident, and then had a massive losing run, and it affected me mentally, and then I started changing my strategy. And then I started asking him more questions, because naturally I wanted to find out a little bit more about potentially what caused him to do that. Was it the fact that he had losing trades that caused him to over leverage, and why he didn't continue? But what was interesting is the conversation kept going back to the 1 month where he did really well. It was as if he wanted to ignore the fact that he'd blown up and not done as well, and kept talking about how great his system was and how great that month was. And for me, it was really interesting, because he was focusing on, firstly, a very short period of time. Essentially, a month is nothing. But, he was really dialing in on that. And no matter where the conversation went, he went going back to this, yeah, but this month was great, and I loved it. And, I was telling my mates how well it was going and all this. And I was like, yeah, but, and then no matter what I did, he would steer the conversation back to that. And it was interesting when we were talking earlier about this before we came into the studio, and you were saying something that I thought was really interesting about that.
Well, just that in a way, it says a lot about his personality. So you could have been a sort of trader who would latch on to all the losing that he'd had. So, more of a fear-based trader. So he's got a more positive disposition, which is a good thing, because I think in trading, turning negatives into positives is a really good thing, because the market's always creating plenty of negatives for you. So, yeah. I when you told me this over coffee, I thought, well, at least he's remembering the positive side of things, and almost, as you say, brushing aside all the negatives that he was doing. So he's obviously got a lot of, there's a lot of hurdles for him to overcome. But I do think that in trading, you need to be able to take a negative and turn it into a positive. So yes, he was latching on to that, and that's not going to help him, because there was all these undercurrents of problems there. But it does suggest that he could have the right sort of disposition to, if he has a second crack at the whip with trading, that if he can find the right sort of direction, and we'll talk about that in a minute as well, all the directions he's been having thrown at him, then he's the sort of trader who could make it. Yeah, because of that.
Yeah, that's how I felt, and that's one of the things I said to him before we parted company. I think what was interesting was that I was asking him, so a little bit more about his system and what he was trading, and not because I thought specifically that was the issue. It was just I was curious. And what was interesting is he was following about 20 different people online. He's telling me all about these different scenarios and order flow and supply and demand and mixing this with this and liquidity. Yes. Oh yeah. Where all the obviously trading like institutions. Again, another complete hallucination that these guys have, that they're following the institutions and all of these buzzwords. And he was saying, you can give me a chart and I can get an idea of the directional bias. And it
lost money.
Lost money. Yeah.
He knows all this garbage, but he lost money.
And it reminded me that essentially when you and it links back to what he was saying about the fact that he was continually reminiscing. It's great that he's got that positive mindset, but what he was avoiding was examining what was going on psychologically that caused a trigger of losing trades, probably an attachment to the fact that he'd had this wonderful month. A few losing trades came in, and it transpired that he started fiddling with his system, started adding in things, changing things, leveraging. And I said, your biggest risk is that you're going to look for the solution, because he wants to get back into it and start trading again. You're going to look for the solution technically, when actually the reason it all went wrong was not because you had 3 losing trades. It's because you had a psychological response, you had a loss response, and that was to over leverage, and you had more losers, and you hadn't accepted that your strategy won't win every month. You latched onto this winning period, you went through a losing period, and then you crumbled. I mean, that's fairly standard. Most traders will struggle during their first losing period. And I kept saying to him, look, the issue will not be your technical strategy. It will be how you deal with the inevitable lose. Yeah, it could be, but if you can't get to the point where you deal with the inevitable losses that are coming, regardless of the technical strategy you're using, you're going to go back and you're going to listen to all these different people. And I made the suggestion, well, why not take a break from all these different stimuluses that you're getting? I know we're here putting out material, but I think a lot of the problem with people these days is there's so much that they can latch onto that inevitably they've got too many information sources.
Well, I think one of the things that they're latching onto is thinking that they need to, like you said, it's a technical problem they've got to solve. So they're going to different people, right, I want to learn your system or this way or this way or this way, this technique. And so he's being inundated, like you said, with various different emails from different companies who have all got their own drum to beat. And he's picked up, as you'd said to me over coffee, various different sort of styles and stuff, because he thinks that the holy grail is in learning and acquiring more knowledge. And yet it's easy for us to say, but really keep it as basic as you can. And what we mean by that is keep it simple. You don't need loads and loads, and you certainly don't loads and loads of systems, and you certainly don't need to know everything. I don't know half the indicators that are out there that are on my charts, that are on my TradingView charts. You know, there's all these I haven't got a clue half of what they are. Don't care.
No.
And so, but of course, when you're a newer trader, you do think you need to know and learn all this sort of stuff, and then that just takes him on a journey of not discovery, of getting himself lost in the woods. And so, yeah, absolutely, like you said, shut off all of that stuff that's coming at you, because if he's got something that may work, and it may not be the case, probably not. I would suggest it probably doesn't, from what you've said, because of it's stuff that's highly marketed.
Yeah, and it's simply it's too much. He's got far too much.
Yeah. So, but he could make something of it. I think that he needs to go back to the drawing board and try and make something of it. But if he keeps following others, then he's just going to be all over the place.
And what was interesting is when he then went into the cycle of, do you know about this indicator? Do you know about this? Do you know about this? And I was like, no. And initially you could see the shock on his face, and then I'm hoping it was sinking a little bit. It's like, okay, this guy's been trading 20 years, and half the stuff I'm asking him, he hasn't got any clue. He's like, do you not follow this person? Do you not? I'm like, no, don't know who.
Why would
literally
you?
No idea. And I'm hoping that that's the underlying message that I wanted to get to him. That less is more.
Well, people that have got into trading in the last few years, if they've gone down a certain route, then there's all these buzzwords, as you've just said. Liquidity zones were never a thing when we were, so that's why we wouldn't use that language, because it was never a thing. It's just a buzzword that people have created in the last few years, really, and they're just creators. That's all they are. And so, and they're making up stuff to make it sound cool for the youngsters. So
well, if you're a new trader and you're listening to a 12-year-old telling you about liquidity and what the big boys are doing,
yeah, exactly.
We think, well, if I trade the way they do, I'm trading with the big boys, and it's little things like this. And unfortunately, as you wisely said, the guy is very positive, and he's got this positive outlook, and he could make it. But that positive naivety, this is what he gets drawn into. This guy's telling me about liquidity and trading like institutions. I'm like, it's not. It's just words. It's just things to pull you in. Yeah.
And I think another thing on that is there's this obsession out there that people think, I can't be like you said this, like a retail trader. I can't trade like a retail trader, so I've got to trade around the institutions because they're out to get the retail traders. Yeah. They're not. They are not. They've got far more bigger fish to fry than you, who's trading at 10 pennies per pip or point or whatever. they're not, the institutions are busy doing what they're doing with their trading. They're not interested in what a load of retail traders are doing, because retail traders will muck up by themselves without any institutions running your stops or all those things that people think is a conspiracy.
Yeah, you've got a guy there that's managing, I don't know, 50 billion or whatever amount of money. He's not thinking about the guy who's got 10 pence, 10 pence per point and stop. Let me go and find him.
Yeah, exactly.
And I've coached guys that have come out of the city who've then retail traded, and initially don't do very well because it's a completely different discipline. And this is the bit I think that these newer traders who are getting bombarded by information need to realise that it's not the same discipline, and the guys in the city are not sitting there trying to hunt you down. It's not how it works. No. So good luck to him.
Yes.
Good luck to him.
Yeah, absolutely. I hope he gets back into it.
Good. So questions. This one, I like this.
Oh yeah.
If you like the look of a certain market, will you overrule your normal trading parameters to trade it?
Yes.
Asking for a friend.
Yeah. I was gonna say, there's nothing to do with me himself. Nothing to do with me. I'm just and if you, blimey. Well, you go first on this.
This is interesting because the language said it all. Would you overrule your trading parameters? What you're basically saying is, if you like the look of something, would you jump on it? And the answer is no, because and both of us trade with discretion in different ways. So we will have a discretionary element to our process and specific entries for different scenarios, but that has to be curbed. I won't look at a market and go, well, I read something in I don't know, on Bloomberg, and somebody said I like the look of the market where it's going. I'm going to jump on that, because the risk is there. Once you start doing that, and I think this is really important for newer traders, once you start doing that, you're opening up Pandora's box. At what point do you say, okay, this is discretion and this is just me jumping on something because I like the look of it, because I've seen a market go up, I've had 3 losing trades, and I want to make some money. So the simple answer is no. I won't change what I'm doing because I like the look of a market. But I think this question is very loaded, and I think it's the idea that asking for a friend. Well, obviously it sounds like this is the sort of thing you're either doing or you're looking for us to say it's okay to go and do it.
Yeah, he's already doing it.
Yeah.
But coming back to that whole thing, this is why you should have a trading plan. So if he's got a trading plan, if it's not within your trading plan, then you can't go and trade it. And using some self-language is quite useful in this situation, and just say, that trade doesn't belong to me. So
I like that.
If otherwise, and even if it does go, so he looks at it and thinks, oh, that's what my setup that I use elsewhere, and this is, I don't know, the Turkish lira, and he's, oh, well, it's got my setup on it, I'm going to go and trade it. Well, have you back tested that setup on the Turkish lira? And what about all the other factors that come into play with a higher volatility, high beta sort of currency, or whatever the market is you're trading? So those are the factors he's not going to see when he's just looking at a chart. And even if it plays itself out, just say, yeah, that trade didn't belong to me. That's someone else's trade. And if you really think, well, okay, I need to go and explore it, well, go and explore it and back test it.
Yep.
But stay with your plan. You're better off staying with your plan than just wandering around aimlessly thinking, oh, that looks nice, or that looks nice. And you end up just becoming like the masses who end up, failing.
Yeah. I really like that phrase. It doesn't belong to me, because it guides you to dismiss the trade.
Yeah.
Because the challenge is, let's say he either watched it or he jumped on it and it works out for him. Well, he's going to bias. He's going to think, well, I need to do that now. He's seen a one-time event. It's gone in his direction, which essentially is a roll of a dice. It happened to go the way he wanted, and he's going to forget or not pay attention to the fact that the same scenario could have cost him 10 losing trades. He's not seeing that, or will, going forward, not acknowledge that, because we're far more likely to acknowledge the thing that we choose to do and it go in our favor, or you choose not to do it and it goes in your favor. But by saying this trade doesn't belong to me, you're forcing yourself to not look at it anymore. I think that's a really nice way of framing it, because
it makes
you
it
can't trade
acceptable.
everything. Yes, it makes it acceptable.
And I think otherwise a trader could build themselves up, get frustrated because they've missed out on that winner that's happened or whatever, but just let it go, like Frozen, and let it go.
Here we go, guys. I knew it was coming.
And and just let that go and use that self-language to help you to let it go. And it just makes it a lot easier to say, yeah, it doesn't belong to me. That belongs to someone else. It's not my trade. And it's fine to let all this stuff go, because you're always going to see markets that are moving and flying off in one direction or another, which may have worked with your approach, but that's random. That's random. If you've got to say, well, what if I traded those markets all of the time? How would it be? And a lot of the time, people are better off focusing on the markets that they are trading and just forgetting about all of the other stuff that's going on.
Good. That leads us nicely on to our last question, which is, how many markets should you trade?
Yeah, it does actually. It's a nice transition, seamless link on this one.
There we go.
Straight into that. And I think it comes down to the style of the trader. Yeah. You know me, I tend to trade like one market most of the time. 80% of my trading is on a single market and then a few other markets around that. Whereas you could have, but I will have, I've got a few different strategies. So I might only be trading 80% of the time on a single market, but I've actually got a few strategies that I can apply to that single market. Now, if you've got one strategy, you might need to have more markets, because one strategy on one market may not be enough. It may be too infrequent. So again, it comes down to your approach, whether you are a multiple strategy sort of trader type thing. I say strategies, but yeah, approaches, methodologies, whatever you want to call them. Or whether you are a singular strategy or method trader, in which case you might need a few more markets. What's your views on that?
Completely agree. I think the risk is, I've worked with traders who have got essentially one strategy, one entry, so one condition within a market. So like you said, they need more than one market because that market's not in that condition all of the time. So they're limited to the number of trades they've got. The challenge is then, so let's say they've got one entry type, one style, and they've got 20 markets that they're scanning for that market to be in that condition. The challenge is when they get proficient and then they want to add in something else. So maybe they want to add in a with the trend breakout style in. The risk is that they then do that across the same 20 markets. So now they've got 40 variables that they're trying to look at, whereas just before they were looking for 20 variables. So again, the risk is sometimes less is more. You don't want to necessarily add in a new style, a new strategy, and replicate that across the same number of markets. You may, now you're trading two styles, need to reduce the number of markets that you trade so that you are looking for different types of opportunities, but over a fewer number of markets, because otherwise you risk trying to chase too many scenarios. You end up missing trades, or it's too much. So it's a real balance depending on what you do.
Well, it's that thing, like you say, once someone gets comfortable with an approach, they always think, well, what more can I do? As you've just said there. And the problem with introducing something like that, like you quite rightly said, and by reducing the markets, that will certainly help. But otherwise, the volatility of their returns massively increases as well. All they see is, oh, I've got strategy A here that's giving me 40% a year, or whatever it might be, and another strategy here that one back tested delivers X% a year as well. Wow, if I put them both together, I'm going to make 100% a year. Yeah, you're probably going to have a 50% drawdown as well, or whatever it might be. Huge drawdowns, and you won't be able to deal with that. And so it's pointless even doing it. So on paper, these things look fine. Plus, a lot of the time, strategies have an amazing ability to get quite highly correlated at times as well.
Yes.
So both of them start failing at the same time, and so it compounds the losses. And
and you've got other things you might have a breakout long position on Aussie yen and something else set up short on a yen pair, and then you're thinking, well, which do I take both? Do I not? And I think people underestimate, like you said, if you've got strategy A 40%, strategy B 40%. Let's say, for sake of argument, they had the same win-loss, but having essentially double the amount of losers. Let's say they both had a 50-50 win-loss, both the same trade frequency. You've got to actually deal with double the amount of losers over effectively the same period of time, and that's harder to do. You've got to place more trades. You've got to make sure that you deal with those losers. But there's also going to be the potential compounding effect of longer runs with more losing trades at once. So there's all these other things that people aren't thinking about. They're just thinking, add them together, double
bubble. One thing, of course, is that you have got some quite clever traders who will actively search for non-competing strategies, ones which are more negatively correlated, but massive hedge funds have done that and still blown up because they will at times be correlated. But I still think that's a good approach to have two strategies which are different, two approaches which are different. Maybe they trade different markets, but appreciate what's the risk. So do a risk assessment of what if they both go, as you quite rightly say, go through a drawdown period together. Yes, they shouldn't do. When one's working, the other one may not. So the idea is it gives you a more even distribution of returns.
Yeah,
that's the theory. It's a lot more difficult in reality, but certainly that could happen at times. But one thing, as always, is that sometimes by combining two strategies, you shouldn't always be looking, as we've said in our joke scenario there, that, oh, I'm going to make 80% now or double, whatever it might be. It might be that you keep the returns the same. So you have a reduced risk per trade. So your risk per trade goes down. So you're not actually going to make any more return, but your risk adjusted returns become better because you've got non-competing, non-correlated approaches. So that is something that certainly can be considered. But I think reduce the risk. Halve the risk. If you put in 2 in now, halve it. You won't make more, but it might be that your drawdowns are narrower. It might be.
I think that's wise words, and there's been many a trader that sat there and goes, "This shouldn't happen," or and it ends up happening.
Yeah,
so,
exactly.
That's good.
Yeah, less is more. Anyway.
Less is more. Good.
Yeah. Brilliant stuff. Yes. On that note, his name's Ali Crooks.
His name's Charlie Burton.
Trade safely out there.